What's up, everyone? Today we are talking about my dividend portfolio or my retire early portfolio, where most of the companies I'm purchasing are dividend paying companies. And this is a portfolio which I currently have in a taxable brokerage account. The reason I'm doing that is for the flexibility of being able to not only buy and sell some of these shares, but be able to pull the dividends at any time before a retirement age. Obviously, I'm seeing this portfolio as an investment. So although I'm thinking of buying a lot more shares, I'm not really thinking of selling them anytime soon. The soonest I would sell any of these shares to buy something else is one, either information has changed on a company where they're no longer a viable investment opportunity or just not the right investment anymore. Or two, I've held this company for 5 to 10 years and I believe that there's better opportunities somewhere else. So as of now, every company that you see on here, I'm already thinking of holding for at least 5 to 10 years. Let's look at the overall portfolio and track your dividends. Now I use this as a reference and kind of a way to completely map how many shares and what my dividend payouts are going to be. But by no means is it perfect. I use my Chase brokerage account to be more detailed, but it's not very user friendly when it comes to showing everything in one place. Let's start with the first thing, which is my current portfolio yield is 4.37%. Now, usually it's not that high, and usually it sits somewhere around the 3% yield. But recently, I did have an options play with IIPR or Innovative Industrial Properties, where I ended up selling a put, and the contract did end up being exercised. So I end up having to purchase 100 shares of Innovative Industrial Properties, in which I do plan on selling a call contract in order to get that investment back and be able to reinvest that money in a more stable company. Now that I will be selling my Innovative Industrial shares that I've currently bought, I just don't plan on having that as a large investment. I do believe it's a riskier company with a great yield, and although I do want to be invested in Innovative Industrial Properties, it's not a company that would make by any means a large part of my portfolio. So let's start with the first company that appears on here, which is AbbVie, ticker symbol ABBV. It currently sits at $152 a share with a dividend yield of 3.98%. They have an annual payment of $5.92 a share. They are currently paying me $31.50 a share. The next stock that I want to talk about is Abbott Laboratories. Their current share price is $108.16. Their dividend yield is 1.89%, and their annual payment is $2.04. They are currently paying me $12.58 a year. Now, this next company is Innovative Industrial Properties. This is going to look very different when I'm able to resell a call option and get rid of 100 of these shares. Usually, I would not be carrying this many shares of Innovative Industrial Properties. So it currently is trading at $88.27. The dividend yield is 8.18%. Like I said, don't chase dividend yield, chase stable, strong companies that pay a good growing dividend. In this case, this is a company that I do not consider stable, but I do consider a company that I want to take a risk and invest in. Only invest what you're willing to risk. And in this case, it makes me very uncomfortable how large of a holding I have on Innovative Industrial Properties. And I will be selling 100 shares of Innovative Industrial Properties and slowly purchasing a few shares of Innovative Industrial Properties at this price, because this company is currently a risky investment. It's currently paying a $7.20 annual dividend payment, and they are currently paying me a whopping $772 a year. This next one's a new one for me, actually. You've probably all heard of it. It's JEPI, or JP Morgan's Equity Premium Income ETF. It's got a dividend yield of 11.63%. Now, these companies, I do like to keep in my portfolio, but with very low shares. I know you hear other YouTubers out there, it's like, hey, how much can you make with $1,000 of JEPI and this and that? And that's great information. The more you're informed, the better. But in this case, I don't feel like these are very stable ETFs or companies that you can really go all out in. They're definitely companies or ETFs that you should keep in your portfolio, but you should have companies with a more of a history and a more stable dividend yield and maybe even a future growth on the share price. What I like about JEPI is that you're not really losing any money in the share price. It goes up, it goes down. Overall, throughout 10 years, you'll see some growth there. But you're still getting paid a nice dividend. For example, right now the annual dividend payment for JEPI is $6.33. So I bought just 5 shares just to get my feet wet and get started with JEPI. I don't plan on making a large part of my portfolio, but it does help bulk up your dividends. That way you can have some stable companies that you know you can keep growing, that'll keep paying you those stable dividends, but you can have other ETFs and or companies that might be paying you a higher yield that you won't see a lot of share price growth, but you might be able to bulk up those dividends and help you retire early. So JEPI is currently paying me $31.66 a year, and that is with just 5 shares. I don't believe in timing the market. I believe time in the market is more important. And as you will see with some of my investments here that I bought even at the height of what some people are calling the bubble, at the height of their prices. For example, Stag Industrial right here. I'm still in the green in Stag Industrial. I bought at the height of the price and have been dollar cost averaging every time I see the price down. I'm up $450 just on share price growth itself. On top of that, Stag Industrial pays me a whopping $282.57 a year. I currently own 192 shares, and technically I think I've bought probably about 180 of those shares. The rest have been the dividends just reinvesting themselves. And yes, it has been a great January, but this week we've had a pretty red week. And as you can see, I have SOFI, I have 242 shares, and I'm up on that $146. Why? Because I dollar cost average. I didn't buy at the height, didn't buy at the low. I bought it when I felt it was a good price to buy, a stable company, and it made sense. So that's what you have to make sure. You're buying the company when the share price makes sense. And not only that, but you're buying the company because you believe in its future growth. You can see the future growth happening in its numbers. Use data. That is very important. Not only that, but some of these companies, you know the share price is not going to grow that fast, and it's not going to grow that high, but the dividends will make up for it. A lot of people like to just point share price to share price and be like, hey, look, this company over here, a growth company not paying a dividend, went up by 20%. And Stag Industrial went up by 10%, let's say. Yes, but you're not counting any of those dividends and their reinvestments. Those dividends themselves can be worth way more, especially since you're going to have to sell that growth stock eventually. You do not have to sell Stag Industrial if it's doing a good job and it's paying you that dividend, unless you see another better investment. I purchased Realty Income. I haven't purchased Realty Income in a long time. I've only have 41 shares of Realty Income, but I purchased them a long time ago and I let them reinvest themselves. I'm still up $292. And I bought Realty Income about 2 years ago. On Stag, like I said, I'm up $450. And then if you see, I bought some PP right here, about 5 of them. I also buy SPY. I bought 10 shares here. I also bought it in my non-taxable brokerage account, so my Roth IRA. And I also purchased JEPI in some of my Roth IRA. I want to make sure that I'm not being taxed for all of my dividends, right? As you know, with Roth IRAs, you can only put so much in, right? $6,000 a year, give or take with the new changes. But if you want to retire early and be able to use it, you're not going to want to take out the $6,000 you were putting in each year, right? And then let the rest reinvest themselves. You want to keep that in there until you need to pull it for either a better investment or, to retire later on. So what you want in the meantime is you want a brokerage account that you can decide, hey, I'm going to sell this to maybe find a better investment. But you have to remember, you're not a day trader. You're looking to invest. Even if it's a brokerage account, you're still looking to hold. So right now, you're seeing these share prices go up and down, and everything looks great, and then everything looks horrible, and then great again. You're seeing the everyday changes. What we're trying to do is invest because we believe 5 years from now, this share price is going to be long gone, and we're going to be 10, 20, 30% higher 5 years from now because we believe that company is going to do a lot better. But that's not always the case, right? I mean, there is risk to investing. But the great thing is, overall in the market, we've seen that 8 to 10% returns. And although sometimes when the stock market is not doing very good, everyone say, hey, the ETF and the safe companies, that's where we want to go. When the market is doing amazing, then all of a sudden you look like a dummy for investing in the safe companies and the ETFs, right? So I think you have to be diversified. I do believe you should be holding some of the stocks and some companies that you feel like will be a strong bet in the future. But you also have to think about, you're taking a lot of risk for purchasing, too many individual stocks. So what you want to do is you want to buy ETFs as well. You want to get yourself in a spot where you're so diversified that one market might go up, one market might go down, and you're fine. You're breathing. You're fine. All right, so back to track your dividends here. So another big one gets Main Street Capital. Now they're currently paying me $74 a year, and they're trading at $39.11. Dividend yield is 6.97%. Annual payment is $2.70. They have a payout ratio of 88%. As you know, Main Street Capital is a BDC. Those tend to be riskier, but I do have to say Main Street Capital is probably one of the most stable BDCs out there that I've seen, and they're currently growing even in this market. So if they can grow in this market, lending to small to medium-sized companies, they're a company that in a bull market it's going to explode and probably do a lot better. Another big one that I have, and I invested and I bought a lot of these shares because I do believe that their share price are going to keep growing up. I bought them mainly when the share price was higher, and a dollar cost average now every time it was around $230. So I bought 18 shares. They currently pay me $49.32. They're trading at $263. So Microsoft Corporation is trading at $263. They have a dividend yield of 1%, pretty much. It's a very stable company. I mean, these are cash heavy company. It's Microsoft. Microsoft name. They have Chat GPT now, which a lot of people are saying, even if it doesn't end up being a huge success with Bing, they have a market share in Bing when the search engine of like 3 to 4%. So even if they end up only being slightly more successful because of ChatGPT, where they get like 10% share of the whole market of search engines, that's a huge win for Microsoft. Yes, Google still owns most of it, but that is Google's main source of income. That's Google's biggest thing. So if Microsoft Corporation comes in here and says, hey, we found another revenue source, and yes, it didn't explode and became the main search engine, but they went and took some of that share price from Google. That's really only affecting Google. Microsoft is only benefiting for that. At this point, if Microsoft were to completely eliminate Bing and its search engine, they're not really losing that much. Yes, there's a profit to be made there, but Microsoft taking any share from Google is already a huge win for them. So that's a thing to consider. They're also a company, like I said, they're cash heavy. They pay a great dividend of $2.72 a year. They're a company that has a huge growth potential. Share prices, it's kind of volatile right now, but it's always been between that $230 to $310 share price with large growth potential into the future. Realty Income, they pay me $122 a year. And obviously, as you know, Stag, Main, and Realty Income are all monthly dividend payers. So it's huge. Microsoft is quarterly. JEPI is monthly, but they're kind of odd. They tend to skip a month here or there, but most of the time they're a pretty good paying company. They're a pretty good paying ETF. Innovative Industrial Properties is quarterly, so they technically pay me around $250 a quarter. AbbVie and Abbott are both quarterly companies, quarterly paying dividend companies. The next one I have is Meet Kevin's PP. As you know, the pricing power ETF that he made. Currently, it is not paying a dividend. He said he's going to be starting paying a dividend, but as you can see, it's still at 0% annual dividend yield. But since I've bought this, it's trading at $21.75, and that's with a red day or red week this week. But I'm actually up on this ETF. I think it's been a pretty good buy. I mainly bought it as exposure for Tesla because I don't have any Tesla shares right now. I think there's more volatility to go, but I do believe that company has huge, strong growth. Like I've said in previous videos, they are kind of the Apple versus Android. It's going to be Tesla versus all other EV companies out there. So everyone comparing any other EV company is going to be like EV versus Tesla, Chevy versus Tesla, Ford versus Tesla. And although I do think some of these other EV companies will eventually take some of that market share, it's always going to be a competition against Tesla. So I want to make sure I'm diversified in that area by buying an ETF that's very heavy on Tesla. I believe Meet Kevin's PP is at 25% Tesla. So another one I currently hold is QYLD. Terrible investment, but I bought them and I plan on keeping them. Their share price usually goes down, but you know what? They have been paying a pretty steady monthly, and I call it monthly because even when they skip a month, they end up paying you twice the following month. So let's say they don't pay you in, let's say they don't pay you in October, and all of a sudden you get two payments in November, beginning at the end of November as well. So QUILD has paid a consistent 16 cents a share at this point. And I would say since I've owned them, I've seen it go as high as 20 cents a share. But really, it's 16 to 17 cents a share in this current market. I do think it's a good dividend paying company to own, to kind of boost those dividend payments, but I would not own a lot of shares of this, and also I would not own or keep purchasing more QYLD. Maybe at this price it's fine, or once it reaches like 17 or higher, I wouldn't purchase any more shares. I feel like it's been staying around that $16.80, $16.90, $16.70 a share. So for the price to really go up, I mean, if you look at its history, at one point it was trading at $25, and it looks like it might eventually go up back up to about $21 a share. If this ever goes up to like $18.50 a share, or even $18, I probably would sell it and reinvest that in SCHD or more JEPI in this case. But as you can see, they're paying me a nice $164 a share. I currently own about 80 shares of this stock, and I've allowed it to reinvest. I believe I technically only purchased about 70 shares of QYLD, and because of reinvestment, it's at 80 now. The next one I am really excited about is SOFI Select. Pretty new ETF, not a lot of people taking a lot of risk. I dipped my toes in it, bought 10 shares. I first bought shares in my Roth IRA, and now I'm buying shares here in my brokerage account. They're currently paying me only $2.14 in dividends, but the growth on this has been great. I'm currently up with SOFI in my Roth IRA, and I'm technically up a little bit on this one as well in brokerage account, even with a red week. I think this ETF has great potential. And then last but not least, my VTI, Vanguard Total Stock Market ETF. It currently pays me $121.36 a share, and I own 32 shares of VTI. I do plan on buying more VTI. I know it's been volatile right now. I've been buying other ETFs and trying to expand out there and buying different shares into my brokerage account so I can diversify my brokerage account more than my Roth IRA currently is. So I plan on buying more VTI, but how I purchase a lot of my shares is whatever the best deal is out there that week, I want to purchase those. So I'm not saying, hey, I have to purchase more VTI instead of something else out there that might be a better deal. I'm going to look at whatever is best that week, and I'm going to purchase that. VTI, currently share price is $205. Yes, I try to buy at least one share here or there, but I want to make sure that I'm purchasing the best ETF and or company out there. And sometimes there's other deals out there that might be a better purchase. For some reason, Track Your Dividends does not update very well, I would say, but it's a good reminder of when your dividends and your big ones are coming in. It's a good way to overall track what you have. So as you can see, February, it's $68, not January. $68. March is going to be $100. April is going to be beautiful at $250. And then it goes on and so forth. It doesn't update any new purchase I made recently. It also hasn't updated the share price from reinvestments will change. So as you know, April, most of that is going to be Innovative Industrial Properties. So Innovative Industrial Properties at the current share price is going to repurchase itself. And it's going to buy more shares of Innovative Industrial Properties. Obviously, it still says it's $250 in July. It's not showing you any of the updates for all the dividends that are going to be repurchased. So guys, that was the quick dividend paying companies in my retire early portfolio right now. Let me know what your thoughts are. If you want to see anything more in detail, maybe eventually I'll put my Roth IRA on here so you can see the overall plan. My 401k, I kind of leave that alone and let it reinvest itself. But a Roth IRA, it is still kind of like my brokerage account where I am being more selective on the share prices I purchase. But what I'm showing you right now is more of that dividend paying companies as well as some of the riskier bets that I have. If you want to look at those as well, like I said, I have Tilray, Curaleaf, SOFI, which I believe SOFI has a lot of potential. I don't think it's going to become a huge bank like the other ones, but I think it's going to compete in a fintech market. It's going to compete in a different way than a lot of those other companies. They also have way less overhead, and I do think that although right now they're giving way too many shares out as compensation to some of their executives and some of their higher level seniors, I do think that the share price will eventually increase starting around 2024, because right now I don't think it's the share price is stable enough. I usually like to say, hey, if a share price stays above a certain level for over 10 days, 10 trading days, then we can start saying, hey, maybe it's going to trade at that level or higher. But right now, SOFI got to $7, maybe $8 close to that. It's now at $6. And hey guys, if you liked the video, remember to subscribe to the channel and hit the thumbs up. It really does help out the channel a lot. It would mean a lot to me as well. And not only that, but you're going to be able to stay in touch with me and be able to comment on my videos, and I will respond as soon as I can. I'll see you on the next one, guys.